Welcome to Earnings Call. Today, we're going to talk about a super exciting company. We're going to talk about Black Knight Inc. So, Black Knight Inc., if you're not familiar with them, is a market leader in software and data analytics in the mortgage and home equity loan space. I know, super exciting stuff. But the company has proven valuable to mortgage lenders and has grown leaps and bounds since spinning out of Fidelity National Finance in 2017. So, what does the company do? The company helps mortgage and real estate manage and track loans across all platforms through their AI and integrated data analytics. So, here's a fun little facts for you. So, US household debt rose over 14.6 trillion in 2020, according to CNBC, with over 10 trillion of that in mortgage debt. That is where Black Knight comes in. So they help banks and realtors track these loans with their mortgage servicing software. So Black Knight operates out of two segments. So they operate out of the software solutions, which is 77% of the company's revenues, and Black Knight's core segment. The software segment helps facilitate and automate the mortgage process, allowing for the uploading of documents, e-sign, and much more. Quarters end, the company is the market leader with 61% of first lien mortgages and 55% of combined first and second lien mortgages. The other segment is data analytics, which provides users with data around property information, servicing data, and lien data. Data analytics make up the remaining 23% of the company's revenues. So that's kind of an overview, quick overview of kind of the company and kind of what they do. Revenues. So the company has been growing revenues over the past 5 or 6 years. As we can see here from this handy dandy little chart, the company is growing. It's slow. It's not going to be one of those big fast movers. The company is projecting over the long term that they will grow revenues around 7 to 9%, give or take. When they IPO'd in 2017, they were estimating 6 to 8%. So some of this is going to be cyclical because it's going to be, I guess, balanced by the growth in mortgages. So as the mortgage industry continues to heat up as it has been kind of prior to COVID and certainly during COVID, as you know, the housing prices have skyrocketed and the demand for houses has skyrocketed. Black Knight has definitely benefited from that and will continue to benefit from that over the long term. The company is a profitable company. If we look at the next slide here, we have the operating margins for the company. You can see that their operating margins are ranged between around 23 to about 26%, give or take. The company is projecting that their operating income and their operating margin should grow to about 25 to 27% over the next 5 years or so. So the company is doing a good job of growing profitability. And if I go to the bottom line, which I don't have a slide for, the company is a profitable company and has shown growth in profitability over the long period. And so the company is doing a good job as far as growing revenues, managing their expenses, and growing their operating margins, which is all awesome stuff. So let's segue into the next part of it. So how are they doing for shareholders and for capital returns? If we look at their returns on equity and their returns on capital, they are kind of they're kind of average at best. And that is really a function of what the company is trying to do. So if you look at the financials of the company and you dive deeper into the cash flow statement, you can see that the company is in growth mode. By that, I mean they're doing things like they're issuing a lot of debt and they're making lots of acquisitions. Over the last 5 years, they've made acquisitions totaling a little over $2.5 billion, which outstrips the free cash flow or the cash from operations that the company is generating. And so because of that, they've had to take on some debt to help fund those acquisitions. They've also diluted their shares a little bit as well along the way to help raise some funds. They've also, on their balance sheet, they have grown their goodwill and their intangibles by quite a lot. And when you combine all those ingredients, combined with the fact that the operating earnings are growing, but they're not growing all that great, when you look at the returns on equity and the returns on capital, they're kind of muted. And when you compare that to their cost of equity or the cost of capital, the margins are pretty slim. In other words, their cost of capital is hovering, depending on how you calculate it, between 5 and 6%. And if you compare that to their cost of capital, then you see that they're actually kind of on the border of destroying value for shareholders. And so that's one of the reasons why this company for me has been it's been on my watch list, and it's kind of on a wait and see for me, simply for the fact that if I look at those returns on capital and equity and compare that to the costs of doing business for the company, they're not generating a lot of growth at that point. Now, they're kind of at the early stages of some of these acquisitions, and they're still in the process of assimilating those into the business and getting the revenue synergies. I hate that word, the revenue synergies to kind of coalesce. And usually when companies go through a lot of acquisitions, a lot of M&A activity, mergers and acquisitions, you're going to see a dip in returns on capital and returns on equity over a shorter period of time, and hopefully you would see those rebound. Now, Black Knight is newer, air quote newer, so they don't have a longer track record like a company like Roper Technologies would or Constellation Software does, and are fantastic serial acquirers and do a great job of assimilating these businesses. So I guess the verdict is still out on whether some of these acquisitions are going to pay off in the long run for Black Knight. And I think for me, that's why it's a bit of I guess, a wait and see on how the company will do over the longer period. If you look at the evaluation of the company, I'm coming up with a value of approximately around $35 to $40 a share. And that's basically because the returns on capital are so muted and so drawn down compared to the cost of capital. The company just can't generate a lot of free cash flow based on the fact that it's costing more to invest than the operating income that they're able to generate right now. If you look at the PEs for the company, right now, the forward PE is around 30. Their past PEs were in the high 40s. So the company, you could argue, was on the border of being overvalued. I would put the fair value of this company probably between around 35 to $50, depending on where you want to go with the cost of capital. And that would probably be reasonable. Company's trading around $71 a share right now. So even with the market downturn, the company is still, I feel like, is still on a little bit of the overpriced version of the company. So I guess those are some of my thoughts on Black Knight. Did you have any questions on after my little diatribe there?
Sure. I mean, I guess, is it fair to say that the idea is that these acquisitions are going to raise their returns on invested capital? And so that's where these kind of optimistic investors are looking at much higher valuations than what a spreadsheet would show.
Yes, they're definitely more optimistic. If you look at analyst estimates for revenues, they're roughly in line with what the company is projecting. I just listened to the latest earnings call, which came out in November, and the company was projecting then around 9% long-term revenue growth. If you look at the analysts, they're predicting 18% for 2021 and around 7 to 8% for future years. So if you average those out, it kind of comes out to roughly the same. The company probably will grow revenues, I think, as they merge, as these acquisitions kind of fold into the operations of the company, will help boost their revenues. But I worry that they won't be able to get to the 14, 15% returns on capital that they probably need to grow at the rates that they're predicting to grow, especially if and when the housing market cools off a little bit, which analysts were predicting was probably hit 2022, 2023 range. If that happens, then that could put a crimp on kind of what's going on with Black Knight as well.
Makes a lot of sense. I feel like that's a good balanced look at the company.
Thank you.